Yes, thank
Okay.
you.
So, yeah, hello everyone. I'm Chris Oxley. I'm a partner for a company called UHY Hacker Young, chartered accountancy firm, both national and international. So we're a top 20 firm of advisors. Really excited to be able to chat to you all today with regards to accounting considerations for social projects and social enterprises. I have a portfolio. I'm a chartered accountant. I have a portfolio of clients within the startup, entrepreneurial, innovative space. So within that as well, support quite a lot of social enterprises. So yeah, really excited to talk to you. So today, in terms of what I'm going to be chatting through, obviously aware of time constraints, so I'll try and get through as much as possible, and there'll be opportunity at the end for some questions if anyone has any. And then also, I'm also happy to go offline and have any one-to-one conversations with anyone that's got anything they want to discuss.
Chris, we got lots of time. Do you mind if we interrupt you with question while you are going through?
By all means, yeah, fire away with any questions you've got in the middle. Don't be afraid. No question's a silly question.
Okay,
so, content-wise, I'm just going to touch on what considerations you need to make for small business accounting and what to look out for. Also then going on to legal requirements for operating a corporate structure, things that you need to do for year-end reporting, other potential tax issues with VAT and payroll. Following this, I'll cover, again, more considerations, but things that you need to look out for if you're looking to or have obtained government grant funding. Also touching on potential benefits, if it's achievable, of receiving R&D tax credits and what this means and what this can do for a business. Going on then to financial modelling and what potentially you'd need to do if this is something that you're looking to go down in terms of an investor route. And then finally, there's just some other considerations just to discuss right at the end. So if we crack on straight into...
I will interrupt you right now. So when you give the comment, can you also mention what might be slightly different for EnduringNet, who is a charity?
Yeah.
If the situation is different, apart from EnduringNet being a charity, it also has got the HMRC recognition as a charity as well. So yeah, thank you.
Fine. Yeah, I'll touch on that just in a couple of slides time.
All right.
So know when we're up to that point. So, okay, cracking on then straight into small business accounting. So it's really important that as a business, you're keeping adequate records because one, you need to keep your adequate records to make sure that you can pull up a set of accounts at the end of the year. But two, it's actually a legal requirement to make a legal requirement for a business to keep hold of certain records and keep hold of certain records for 7 years. Now, 7 years. So you've got to make sure that you've got those records handy and available if HMRC or any other governing bodies were to request sight of them. So what are these records? Firstly, sales invoices. Now, this might not necessarily be applicable to EnduringNet at the moment or any other social enterprises, but sales invoices are records of any potential income that you're receiving or revenue you're receiving as a business. So if you are selling anything, selling either a goods or a service, there needs to be an associated sales invoice that goes out with that sale to the customer. And it's really important that you keep hold of those. They've all got a separate sales invoice number and they all contain relevant information such as the customer's name, their address, the amount being charged, and what service is being delivered. Secondly, any kind of funding income that you receive. Again, if it's something like Innovate UK and you've received grant funding from Innovate UK, again, you'll receive offer letters and supporting documentation with that grant funding. Again, it's really important that you keep hold of those because there's lots of differences between different grant fundings and how they're taxed and how they're treated in company accounts. So it's really important that you keep hold of all that record so that when you get to your year-end point, then you can correctly treat them within those set of year-end accounts.
Could you briefly touch on like which will be taxed and which won't be taxed, like for example?
So in brief terms, again, it's quite complex, but in brief terms, if you've received a piece of grant funding for a specific project, then the way that it works in terms of the taxation of that grant funding, all grant funding is taxable, but you won't necessarily pay tax on that grant funding if it's for a specific project, because any income that's not been spent by the time that you get to your year end point is deferred to the next year. So you'll never ever, you'll never get to the point of making a profit in that business, which would be taxable, because the income's always offset by the expenditure. Now, on the other hand, if you receive just a generic grant or a prize from a competition that's a set pot of money that you can do whatever you want with, then if you've not spent that by the year end point, you will get taxed on any profit that's sat within the business.
Wow.
So it's really important that you know that. And if you've got a prize, and say for instance you've received a prize of 30 grand and only spent 15,000, potentially you've got a £3,000 tax liability at the end of the year. But you would only then receive we'll say a refund back from HMRC if you then ended up spending the money in a later year. If you never ended up spending that extra £15,000 in that example, you'd always have a tax liability on that income. So it's really important that you understand the differences and then keep adequate records of these funds that are potentially received, because they're treated differently within a set of company accounts.
What happens if we are charity? Is it still apply?
Depending on the nature of those funds, yeah, it still would apply, because obviously as a charity, you've probably at the moment set yourself up as a not-for-profit charity, and so corporation tax doesn't apply to any income. However, as soon as you receive other income that potentially is profit making, which this grant funding would be, then potentially you've got a corporation tax liability and would need to reapply for corporation tax on that.
Okay.
Now, Innovate UK isn't. So Innovate UK very much is a restricted fund for a certain purpose. So that doesn't create rise to taxable income. However, as I mentioned before, general competitions or just general grant income is potentially taxable.
Right. Thanks for that. Never know that. Yeah.
So yeah, just make sure that you know the differences and you keep track of the different amounts coming in. The biggest records really that are going to be for Enjoying Net or any other charities is purchase invoices and expenses, anything that you're incurring to go out and deliver the project, overhead costs, etc. And again, as I mentioned at the start, keep hold of them at 7 years. Keep hold of those receipts and invoices that you receive for anything that you've incurred for 7 years. But it's also important that you note down, with regards to those expenses, how they're being paid, when they're being paid, and who's paying them. So say, for instance, you've got an expense out for a new laptop, just as an example. If you've paid this directly from a business bank account, you need to note that it's been paid from a business bank account. If you've paid it from your personal funds, for example, and are looking to claim back from the business, then again, you need to note where that expense has been paid from. And it's really important that you do that. Otherwise, once you get to your year-end point, you then can't reconcile your bank account. So, and again, on the next slide, I'll go into a few different tips for how to keep records, but it's really important that you note those things down. You note where something's been paid from, the date it's been paid, and then also where that's physically gone from. Similarly, if you're paying anyone that's off payroll, so contractors or workers for the business, again, make sure that you're obtaining some form of evidence of what they've done. Normally, this would be, again, an invoice that they're sending to you to get paid, but make sure that that invoice stipulates exactly what's been done and when it was done, and a description on those activities, which then show that it was actually a genuine business expense. And then finally, your bank statement. So again, this just needs to be business bank statements, but it's really prudent to obtain physical copies of those bank statements. So not just a CSV download, but also a physical bank statement image, if you're doing it digitally, covering your year-end point, because your accountant will want to see that to make sure that you've got the correct amount of funds in that business bank account. So as I mentioned, digital copies are acceptable. So you don't need to keep hard copy of all of your receipts and all of your accounting data. Obviously, if you've got a lot of transactions, that can soon mount up with regards to pieces of paper. So get a scanner, do it on your smartphone, get images, put it onto a hard drive, and keep them all safe. And it'll be a lot easier to store then at that point. So then just touching on in terms of how you should be physically keeping these records. And again, this is going to depend on the size of the project, the size of the enterprise, and the amount of transactions that you've got. Now, the easiest and simplest method is just Excel. So using Excel as a tool just to keep record of any income and any expenditure incurred. Now, what I'd advise if you are using Excel, obviously this can get quite heavy if you've got large transaction numbers, but let's assume at the moment you don't. you need to again be keeping record of the date that anything was either received or incurred, a description with regards to the nature of what has happened. So what's been spent, what's it been spent on, who the customer or supplier was, and then the amount that's incurred as well. And it's really important that you keep record of all of those different fields so that when you get to that year end point, you can then produce a set of accounts from that data. Now, if you do have large transaction numbers or the enterprise is growing to a certain size where it's possible that you need something more in terms of recording data and getting better information out from your systems, you could start to jump onto the likes of Xero or QuickBooks as cloud accounting platforms. Now, they're fantastic at what they do, these platforms. However, they do come with a cost, and the typical cost to go on one's about £30 a month. So as a small project or a small enterprise, it's not necessarily something I'd recommend. However, if transaction numbers are growing, it's really good then for being able to start automating processes, because what you can do is you can literally just take a picture of a purchase invoice, for example. It reads all the information off that purchase invoice and then puts it into your accounting information for you. So in terms of that data entry, especially if you do have large transaction numbers, you can really start to drive automation and drive efficiencies with that back office.
Can I interrupt you there? I remember going into HMRC, I think sometime it does say something like, are you using certain platform or something? Has this got anything to do with that?
Yeah, so with regards to filing VAT returns in particular, so you might have heard that HMRC are going on a big initiative at the moment with regards to making tax digital. So this is started off just with VAT registered businesses at the moment. So what they're stating is that you need to submit, you can't just log on to HMRC's website anymore and file a VAT return. Instead, you have to go onto one of these platforms, prepare your VAT return on there and submit it directly from the platform. Now, at the moment, as I say, that's just for VAT registered businesses, which potentially not a lot of these social enterprises will be VAT registered. However, HMRC are expanding that making tax digital initiative to then cover non-VAT registered businesses and sole traders as well. So at some point within the next 3 to 5 years, the likelihood is that every single business submitting returns will need to be on a cloud accounting platform of some sort.
Right. Okay. Thank you.
So, I mean, as I say, they're not a necessity at the moment. So you need to weigh up the cost benefit of paying £30 a month. But once you do get to a certain size, it's definitely worthwhile looking at it, because, and especially if you're going down the route of a social enterprise that's potentially looking to seek investment from outside investors, then they're going to want to see more data than what's just contained in an Excel document. So something like Xero or QuickBooks will do a really good job for that. So in terms of then legal requirements is going to depend on what kind of structure that you're going to set the project or enterprise up in. Now, and this kind of touches on your point earlier with regards to charities as well. So your different type of corporate vehicles, you can operate as a sole trader, but in terms of an actual corporate vehicle, your different types are either limited company by shares, limited company by guarantee, or a public limited company. Now, public limited companies are large companies listed on the stock exchange. So for the purpose of this, we won't discuss those any further, but limited by shares and limited by guarantee are both just general limited companies that are incorporated with Companies House. Now, they both have limited liability status, but really where the difference lies is the nature of how profits distributed in each business. So a limited by shares company has shareholders. So shareholders buy shares in this business to then eventually benefit from obtaining dividend income, so that profit out of the company into their pockets. Whereas a limited by guarantee company doesn't have shareholders. It has members that have guaranteed a certain amount of money to the business to cover any liabilities if something.
Chris, can I interrupt you there?
Sure.
Enduring that is limited by guarantee. In fact, when I was registering Enduring that, I was quite surprised that when we register at the Company House, it allowed us to have the guarantee to be limited to £1 per person, per director.
Yeah.
So, I mean, I'm glad that this is so easy for Enduring that, but as a citizen, I was quite alert that the guarantee is so little, in the sense that
Yeah.
how do you get
So,
people penalized for their wrongdoing if
right,
they're only
okay.
responsible for
Yeah,
£1?
yeah. So you're right that you can have you can have it as low as you want to. You could have it as a penny if you wanted to, with regards to, especially within a limited company by
Why
shares.
it allows people to have such a low guarantee?
It's because of that, then, this veil of incorporation. So when I've put on your responsibilities on the next point, within Companies House, there's a big section that states that directors have certain responsibilities in the business. Now, these responsibilities are pretty straightforward, but they're designed to stop any fraudulent activity. So what they state is that a director needs to be acting in the best interests of the business, and any decisions that they need to make are in the best interest of the business and then the stakeholders. Now, if they're not, so if something fraudulent was to go on, so say, for example, a director went and took a loan out for £100,000
Okay.
and then took the money out, spent it on whatever they wanted to spend it on, personal stuff, and then either close the business down or try to make it insolvent or something along those lines. Now, if fraudulent activity like that's been carrying on, then that whole veil of incorporation, that limited liability status, disappears.
Okay.
So when you say that, well, they've only got a guarantee of £1, or they've only got a share of £1 in that business, if they do something wrong, they're no longer protected by that.
Okay.
So
yeah, I think I remember reading something like that. The other quick question is like for shares. Yeah. So if you limited by shares or public limited by shares or something, it's very easy to create, for example, sister organization whereby I hold your shares and then you hold my shares or something like that. For charity, if we are limited by guarantee, for example, have you ever come across like how do two charities
so it doesn't work like that. So you're right. You'd need to change the structure to a limited company by shares, and then have some kind of shareholder agreement in place that states that no profits are going to be paid out. Because the whole point of a limited by guarantee business is that if someone's looking from the outside, they know that none of that profit is going to be distributed out to shareholders. It's going to remain in that business for the benefit of what the business is doing, that social aspect of the business. Now,
so how does a limited by guarantee charity becomes international then?
There's nothing to stop you setting up, in effect, different branches underneath that one limited by guarantee business. A branch isn't a separate entity in its own right, so that's an option. You could go down the branch route. It's not a separate subsidiary, so it's not a group of companies. It's still one business that just is in effect trading in a different country. So that's definitely an option. There's nothing to stop you trading internationally anyway from just that one business without the branch.
If I have a branch in Singapore, you'll be taxable in the UK.
Yeah, that's the thing then with all of if you've got branches, your branches aren't separate entities, so they're still taxable in the UK. So that's why potentially a business would want to be structured by shares and have different legal limited entities in all of the different countries they're trading in, because potentially then any profits that are in Singapore, for example.
So if we are limited by guarantee, is it a very painful process to change it to limited by shares?
You have to close the company down completely. So it's not incorporating it, so you do have to close it down. Now, it all depends then on what type of assets that you have in that business.
All right, that's very painful, isn't it? So if we do go through that process, do we still can we still use the same name, and then like all the IP, and
so this is your issue, isn't it? Anything that you've signed within that business name,
then it will no longer, it'll be different legal entity.
Yeah. So that's the painful process. So it's something that you're better doing earlier if that's what you wanted to do. And I'll touch on a few areas later with regards to things like investment that would impact your structure and the need to go into a limited by shares business.
All right.
However, it's definitely better to do it earlier rather than later if that's the plan for the entity. So it's good to have a clear idea of, well, what are our goals and where do we think this is going to get to, and then what structure is that?
Okay.
So so they're the differences between the three, I suppose. Obviously, public limited companies aside, because we're not going to be dealing with those. And obviously, I've mentioned with regards to directors' responsibilities, and it's important that regardless of either a shares or a guarantee structure, you're abiding by those directors' responsibilities. Because if you don't, that limited liability status disappears. But either way, for both guarantee and shares businesses, you've still got filing responsibilities as soon as that business opens. So as soon as you've incorporated that company, you'll have a date that you need to submit a set of year-end accounts by. So your year-end accounts, for example, if you incorporated a business in on the 5th of January 2020, as just a basic example. Now, what Companies House will state that you've got to file a set of accounts that covers one whole year up to the end of the month where you incorporated. So in this example, that business is going to have to prepare its first set of year-end accounts going up to the 31st of January 2021. Now, it's then got 9 months to submit those accounts to Companies House. So obviously that's then by the 31st of October 2021 in that example. So you can change year-end dates if you want them to be in line, say, with the tax year or a different period. However, as a default, they always go to the end of the month that it's incorporated plus a year, and that's then going to be your year-end date. So you've got a set of accounts that you need to prepare once a year, that cover a 12-month period. You also then potentially need to submit a corporation tax return as well. Now, as you mentioned at the start with regards to charities, quite often if charities or not-for-profit organisations aren't going to make a profit, you can notify HMRC of this and they'll state, right, okay, we're no longer going to request a corporation tax return from you. However, by default, you will be registered for corporation tax. So you need to notify HMRC when you're starting out on a project that we're not for profit making and we don't need to submit corporation tax returns.
So in fact, I found this very confusing at the start in the sense that we have to file with the company house and we also have to file with HMRC.
Yeah.
And then
they're both on the same date as well.
Do they have the same year end?
Yeah, so what corporation tax returns look at is then the accounting period that's been filed for your year-end account. So it's the same period, and then it also needs to be filed. Well, the corporation tax return is filed 12 months after the year end, but any tax liability is paid on the same date as the company accounts are submitted, so the 9 months date. So it is confusing because as well with the corporation tax return, you also need to send a copy of the company accounts as well alongside it. So as a business just starting out, let's assume that you're not exempt from corporation tax.
Yeah.
You've got year-end accounts to file by 9 months after your year-end date. You've also then got to pay any tax on that day. And then you've got an extra 3 months, so 12 months after that year-end date to prepare and submit a corporation tax return.
Yeah, so is there any chance that this date might be different? And then if they are different, then we have a way of synchronizing them.
Yeah, so in your first year, the dates are normally then slightly different in terms of when things need to be filed by. However, after that, they always fall in line with the last day of the month, 12 months after the year end or 9 months after the year end. Now, as I mentioned before, you can change those dates. So if, for example, in that scenario, your year end was 31st of Jan and you wanted it to be 31st of March, you can change your company, you can change your year end date of business with Companies House, and then you'd have to notify HMRC that chargeable accounting period is different and it goes up to the 31st of March. So you can change it, but you'd always need those two end dates to be in line. You can't have different dates.
To be honest with you, I already pay £100 penalty for getting the date wrong.
Okay.
So confusing, like you said, the first one, you know, you count how many months and then it's different for different.
Yeah. So the first year, normally then in terms of the actual filing deadline is slightly different. So you always have to be careful in year one.
Right. Okay. I might talk to Sarah later to try to get the date synchronized, avoid getting so confused. Yeah. It's
just, and it's prudent as well, just to make sure that as soon as you get past your year end point, you've still got at least 9 months to get those accounts prepared. So get them done early. As a rule of thumb, just get on it early and make sure you've got all that record that I mentioned before in a good format and get on those accounts early.
So basically just two sets, one for Company House and then one for the HMRC. So the Charity Commission does not need anything.
If you registered with the Charity Commission, they will need to see a set of year-end accounts.
Oh my God. So we still need to file with them.
Yeah, you'll still need to file with them. But again, it's going to be the same documentation that you're submitting to Companies House anyway. So I haven't
yet filed with Charity Commission. I hope there's no penalty for that one.
Yeah, you'll need to check the deadlines for that. Potentially There could be, but the charity commission are a lot more lenient.
All right then, yeah.
Okay. So check it out. But if you need any help on that, just shout.
Thank you.
But then as well with year-end accounts and corporation tax return, each and every year on the anniversary of the incorporation date, you've got to file something called a confirmation statement. Now, confirmation statement is really straightforward. So there's nothing overly confusing in it. It just is a document to make sure that the records that are on Companies House are up to date. So any shareholder or member details need to go on there, address of the business, its trading activity, etc. So just basic information on the business needs to be updated at least once a year to make sure that it's accurate. And that's the confirmation statement. Now, with the confirmation statement, you also have to pay Companies House to file it, and that's £13 at the moment to file a confirmation statement.
Yes, I've done that, yeah.
Perfect. And then finally, depending on what the business is doing and what remuneration you're receiving from the company, you'd potentially also need to file a personal tax return as well. Now, if the company is limited by shares and you're a shareholder in the business and you actually do receive profit out, which potentially isn't going to be the case for a lot of social enterprises, you receive it in the form of dividend income, which isn't taxed. So you need to submit a personal tax return to pay tax on that dividend income. Now, assuming that's not the case, you'd only need to file a personal tax return if your remuneration as an officer of the business was over £100,000. If it's below that, then you don't need to file a personal tax return unless there's any other need away from the business for you to do so.
If we file tax return anyway, so any income from the charity will have to be filed, isn't it? Is that right?
If you're receiving income out that's not paid via PAYE, so salary, then yes, you need to submit that on a personal tax return.
Okay. I just want to ask you a question. When I received the confirmation from the HMRC that EnduringNet is a charity, and then they also have a column about all the personal information. So they actually said that me as a director and also another of my colleagues, Ken Foster as a director, somehow can claim something personal to our personal income tax or something. Are you aware of that? Maybe I'll come back to you later.
Yeah, come back to me on that one. Yeah,
all right,
I'm not sure what you mean on that, but
I was just very confused about why should these declarations of the charity status by HMRC, what has it got to do with anything personal to me as a director?
Right, okay. It all depends then if you've actually made any charitable donations, I think is what you're possibly referring to.
Okay.
And I won't go into it at the moment now in depth, but the way that it works is you potentially can get tax back on charitable donations.
All right, okay, fine.
All depends on what income you're receiving though.
Okay.
But yeah, so that's your potential responsibilities when you're running one of these, a business either by shares or guarantee. Now, again, very briefly, depending on the nature of the business, it might also be the case where you have to register for VAT, or you might want to register for VAT. Now, as a business, you can only register for VAT if you make taxable supplies. So if you're not making any taxable supplies, so this would be where you're potentially selling something, selling a service or a product or some goods. If you're not doing that, potentially you're not going to be able to register.
Where do we find this list? I mean, like sometimes some items are different VAT rate as well, isn't it?
Yeah, exactly. So it's really complex with regards to VAT and what carries certain VAT rates, either at 20%, 5% or 0%. There is a big list that I can send out that's on HMRC's website, but unless you're a VAT registered business, then it's not going to matter anyway.
So for example, a lot of our work, mostly our humanitarian work. Say, for example, if we had this kind of really, say we have this contract with a care home, for example. So this sort of thing, would it be VAT then?
Well, if you've got it, what exactly are you going to be delivering?
Let's say hypothetically, just use the COVID passport example, and then we go in and then we install all these Vein ID scanners and then help them to set up the digital COVID passport. Yeah, so that potentially is taxable income. So with regards to that, you've got a decision to make then. With regards to the income that you're receiving, if in a year, over a 12-month period, that's going to be in excess of £85,000, you will have to, by law, register for VAT. If it's below that, you can choose to register. Yeah, so what you're saying here is that as a charity, even if we are not paying corporate tax,
you'd still have to register.
We still have to pay the VAT.
Yeah.
All right. Okay.
So if you're VAT registered, well, firstly, if you're not VAT registered, any costs that you're incurring that's got VAT on it, you wouldn't be able to claim back from anywhere. You just have to suffer that. You're the last person in the chain as the business, and you pay the VAT across to the customer. Similarly, with regards to any potential sales that you're making, you wouldn't charge VAT on it because you're not a VAT business. Now, on the other hand, if you are VAT registered, any sales that you make would be charged with VAT on. Now, the VAT rate that's going to be charged on that will depend on what's being done and what your customer is. Potentially in the care industry, it might be 0%, but we'd have to have a look at that. But you're going to potentially charge VAT on your sales. But the benefit then of being VAT registered is that any costs that you incur that have VAT on, you can claim that back from HMRC. So say, for example, you're delivering care services that potentially carry a 0%, and you put a sales invoice in for £20,000, for example.
Yeah.
Just be £20,000. It wouldn't be £20,000 plus 20% VAT because it's at a 0%. Then on the other side, in order to deliver that contract, if you'd incurred costs to a supplier of £10,000 plus 20% VAT, you'd have paid that supplier £12,000. Now, the benefit then of being VAT registered is that £2,000 of VAT, you'd then, on a quarterly VAT return, submit it and claim that back from HMRC. So in that example, you'd actually get a refund of £2,000 just by being VAT registered.
So even though I service the care home and then I did not have to pay VAT, but because I pay my equipment and then I got suffered the VAT charges, I can actually claim those money back. Yeah.
If you're VAT registered.
Even if I'm not paying any VAT at all.
Even if you're not paying VAT because you've not received it in, because your supply is still a taxable supply, but it's at a 0% rate.
Yeah.
So you've never received any VAT in from your customer to pay to HMRC because it's at that 0%.
For some reason, I was under the wrong impression that there's some kind of account, like a credit account. Then I pay how much for VAT, or I charge people how much for VAT. Then I can claim back how much I pay. So what you say is not. It doesn't really matter.
That calculation, if you're VAT registered, is just done on a quarterly basis. So every 3 months, within your VAT return, you look at, well, what VAT have I received in on my sales? I need to pay that to HMRC. But then you can offset against that any VAT that you've incurred. But in that example, you didn't get anything on sales because it was charged at 0%.
Yeah.
You've incurred costs, so you could claim that still back from HMRC. So it all depends on what you're doing. But VAT returns are submitted on a quarterly basis.
Okay, so this, I just want to clarify this because I got slightly different information from someone else. So for example, the example that my accountant, the university accountant was saying, like, so if we charge BP, we deliver some services to BP, teaching consultant, whatever. And then later on, we have got some services from BP, and then we have to pay them. Only when it is the same entity, then we can offset. But if it's a different services,
it doesn't matter who it is or who you're paying. There's nothing to do with the same entity. So in that example, that supply to BP is likely to be at a 20% rate. So if you were VAT registered and say, for instance, the contract was £10,000, you'd then have to charge BP 10,000 plus £2,000 VAT. So you'd receive from them, rather than at the moment you'd receive 10,000, being VAT registered, you'd get 12,000 into the business. But £2,000 of that's not your money. You have to pay that to HMRC within your VAT return. But any VAT that you're incurring on any costs, so what you're spending, then you can claim that back from HMRC within that VAT return.
Okay, that's good to know. Thank you. Yeah.
So that's VAT. Your next issue potentially is payroll. And
sorry to interrupt you again. Why do you have a deregistration that is a different number?
Yeah, okay. So with regards to deregistration, as a business, if you're VAT registered, you can only deregister for VAT once your turnover goes below 83,000. So it's not below 85,000, or 83,000. It's to cut out any businesses that are potentially just borderline. So where
can you constantly oscillate year to year?
You can do, and you can register and deregister whenever you want to as a business, but you need to always look at that 12-month rolling figure. So potentially, you wouldn't ever fall out of that VAT regime. depending on how much income you've dropped by in a year, I suppose. But you always have to assess it on a rolling 12-month period.
Okay, right. Thank you.
So yeah, with regards to payroll, then payroll's quite a complex area, especially with regards to paying people off payroll. There's a lot of legislation that HMRC have put out there to catch businesses that are potentially paying workers who should be employees but don't pay them via a PAYE scheme and just pay them as a contractor. And the reason for this is because an employee, if you're employing someone, you'll make sure, one, that HMRC are getting their tax money in, but you'll also then pay more tax overall by paying an employee rather than a contractor. And similarly, a contractor receiving the money, they'll potentially receive more if they're operating as a contractor rather than an employed person of a business.
Yes.
So there's a lot of legislation out there to stop that, and it's complex, but in simple terms, what you need to think about is supervision, direction, and control. And they're the three big terms really to understand whether someone is or should be an employee of a business rather than a contractor. If they're supervised in what they do, if they're controlled in what they do, and if they're directed in what they do, then they should be an employed person. So you've got to think about that master-servant relationship. If that's in place, if you can tell that person exactly what to do, when to do it, and how to do it, then they should be employed by the business, and you shouldn't be paying them gross as a contractor out. So really complex.
Now I understand all those questions we were asked when we set up a new supplier.
Yeah. So because at the end of the day, if potentially if you get it wrong and you don't pay this person on payroll and pay them off payroll, and really they should have been an employee, you as the business are the one then that suffers the penalties and the tax and national insurance. So you could have paid someone a contractor rate out and then also have to pay penalties and tax on top of that. So if you don't get it right, it could be quite costly. So assuming then that you do have employees, or you want to pay yourself out a salary from the business, then you're going to need to set up a PAYE scheme with HMRC. Now, it's a relatively straightforward process to set it up. However, once it is set up, it's quite onerous in terms of what you need to do to keep records and submit returns for this. Because what go on, sorry.
Pay as you earn is more like a regular kind of thing, isn't it?
Yeah,
but what if a lot of our work is project based? If there's no project, there's no income. In fact, a lot of the income are really cost based rather than a gigantic salary. Do you know what I mean? Yeah.
So it all depends then what role that individual has within that business. Now, potentially anyway, if you're a director of a company, then again, there's certain stipulations and rules with regards to office holders that they should hold employment for what they're doing. So again, there's complex areas with regards to a director can't necessarily just, even if it's project based and it's once every 3 months or 6 months and there's no guarantee of more projects coming in, that office holder, that director would still need to receive their remuneration from that business in the form of a salary rather than paying it out.
Does this matter if the people are not in Britain?
Well, this just makes it easier then to not put them on payroll, because how are HMRC ever going to find out about those people operating and how they're operating and looking into that working relationship? And again, I'll discuss that briefly on the next slide, which goes into overseas workers. But assuming that you're just a general office holder, potentially you need to be employed by the business. So you'd need to set up a PAYE scheme. Now,
do we get fined if someone later on arguably supposed to be on pay as you earn, and then we didn't do it? Do we get fined?
Yeah, and potentially that person who's a worker but is really an employee could then come back to the business and state, well, I was an employee. You've not paid me any holiday pay, you've not paid me any sick pay, and you've not paid me, if they're not working there anymore, potentially any redundancy pay as well. They could argue that. They could turn it around and argue that they should have been employed and that you wouldn't pay them. So just be careful on that front. Now, let's say cost of employment, it costs more to employ someone than it does to pay them as a contractor, because you've got to pay them employers NI, and potentially, as I mentioned just then, you've got to pay them holiday pay, sick pay if they're ill. And potentially other benefits as well. So it costs more, so bear that in mind. It might be that you need to pay that person a lower rate because it costs more to pay them. But each and every time that you pay someone through PAYE, you need to submit those details to HMRC through what's called a real-time information submission, an RTI.
Yeah.
So potentially, if you're making monthly salary contributions, paying someone, you need to be submitting your payroll details every single month. And what is on top of that as well, now with added complexity with payroll, is that as an employer, you also have to offer a pension. So potentially, you've also then got auto enrollment that you have to deal with, and submissions of pension details every single month as well.
In fact, we have a very big argument with Innovate UK. So apparently, like UK grant, Innovate UK probably is one of them, in the sense that they are very British, right? So they really wanted everything British. And apparently, I think they might be in the small print, but we actually learned it from the monitoring officer. They say that you can't pay any labor outside Britain. You have to pay someone in Britain. So then the proof of you pay someone in Britain is that you set up this pay-as-you-earn scheme. Then I say, enduring that has no salary, have no salaried person, has no fixed person. We are all virtue. It's very crazy to force enduring that to set up a pay-as-you-earn with someone.
Yeah, and this goes back to pressures from government to stop off-payroll working. So with regards then to if you're genuinely paying a business, a subcontractor for work, then that's allowable, and that goes under a different cost category. But any type of labour costs, again, it's just another way to make sure that people are paid on payroll, because at the end of the day, HMRC get more money in if people are paid on payroll rather than off payroll.
So with the government grant, there is a hurdle like that. Yeah.
So it's something to be aware of, and it all goes down to when that grant's issued, because at the end of the day, as I mentioned before, that potentially you can have subcontractors, people paid off payroll. But
so is subcontractor a good solution then, in your experience?
Yeah. But again, it comes down to that contract of employment. So on the next slide, I think I'll just go into that.
All right,
like, paying workers, and this is workers in general. Here I'm going to go into overseas workers, but any worker in general that's not employed, you need to make sure that you've got a contract for services in place. So a contract for services that states that that person's not an employee and that they're in control of exactly how they're going to do that job.
Yep.
They're just being paid for that one project potentially. There's no ongoing work. So you need to make sure, and it's even more important this for paying overseas workers as well, that you've got a contract for services in place. With any overseas workers that aren't on payroll, you need to make sure you've done anti-money laundering checks. So you know exactly who that person is, who you're paying. You need to make sure you put in place a deliverable schedule. So again, you've got yourself protected with regards to what should be done in that project. How long is the project going to last and what needs to be completed? Because at the end of the day, if they don't deliver it, and you've not got a delivery schedule down stating what needs to be done, you're never going to be able to argue that they should have done something, because you don't have anything written down that they've agreed to. And also you need to make sure that you're requesting an invoice for any overseas workers as well. So an invoice needs to be there. Again, stating, as I mentioned right at the start on invoices, who they are, what they've done, and the amount being paid.
Yeah, in fact, you mentioned there, interesting, that no withholding tax. In fact, it took me so many sleepless nights to search for this withholding tax information, because we are paying someone in Austria. So I search and search.
So, there's no withholding tax, and then it's up to that individual then to make sure that they're submitting the relevant details on their own tax return in their country and paying the tax there. Now, within the UK, there's certain rules that this isn't going to affect you in the area that you're in, but the UK is starting now to try and capture that information of who's been paid out, because at the moment people are getting paid willy-nilly and it's not being recorded anywhere other than obviously your year-end accounts. But within the construction industry, this is then
to be honest with you, Chris, the last time when I was filing the HMRC tax return, it actually asked about the foreign currency that you pay out. It did have that question, so that's why it alerted me. Like I was kind of very worried about this labor, especially we have one Austrian volunteer, and then we call contractor or subcontractor.
Yeah, at the end of the day, it's all to make sure that all of the government bodies are receiving the correct amount of tax. systems and processes are improving year on year with the artificial intelligence. So all of the worldwide governing bodies are trying to work together to make
the
sure
only thing I just need to know, like whether it is my responsibility or is that Austrian responsibility?
It's the Austrian person's
Okay,
responsibility.
that's great. Yeah.
Providing that it is a genuine contract for services. So again, going back to the bit that you need that in place to pay them, it's their responsibility. Yeah. So then obviously with regards to paying overseas workers, if they are genuinely employed, then you do need to put them on a PAYE scheme. Again, going back to what I mentioned before, I won't go over it again, but if they are employees, even though they're overseas, they should be on a PAYE scheme. And again, this is another complex area with regards to taxation, because if it all depends on where that employee is a resident, and then also how long they've been outside of the UK, and whether they come to do work in the UK or if the work's done remotely. And all of those factors then come up to an answer on how they should be taxed. But potentially, if you've got someone delivering services fully remote, they've never stepped foot in the UK, then even though you're submitting their details on a PAYE scheme, they could potentially receive full UK tax relief on any income being paid out. So it'd be the same in respect of what they've received as a contractor, but through a PAYE scheme. So you're covered as a business that you're paying them correctly, but you're not paying any more tax on it.
Yeah, actually, I'm very scared about that when I was thinking about that because of that Austrian, in the sense that when you start to declare that Austrian as an employee of Enduring Net, for example, because they are Austrian, or let's say maybe they're Chinese from China, do we need a work permit?
So they'll need to potentially obtain a work permit for working here,
even if they are not in the UK.
If they're not in the UK, no, because they're not stepping.
But you are registering them in under PAYE.
Yeah, so then this is then the big issue that they'll need to obtain a national insurance number here, and it's really, really tricky to obtain a national insurance number when you're not a resident in the UK. You have to obtain something called a temporary national insurance number.
Okay, but we don't have to worry about visa, but worry about employment pass.
No, because they're not stepping foot in the UK.
Okay, that's good. Yeah, I'm so worried sick about this, Also, because I think it's kind of quite difficult, isn't it? Because especially
the information's not really there either to search for it on your own. So it's quite important, if any issues like this arise, that you surround yourself with decent advisors, tax advisors, etc., that can support.
All right. Yeah.
It is very, very complex.
I know, and then like trying to search on the internet for all this information, it's not so easy.
And you end up going down websites that aren't official websites, so you don't know if the advice you're getting is correct.
Yeah. Thank you. Thanks for that. Yeah.
So moving on then, conscious of time, next I just wanted to briefly touch on government grants and just some tips on what to do if you are obtaining grants from the likes of Innovate UK, for example. Now, it's really important that you keep accurate records of what you're incurring, including breakdowns of things like labour, any overhead costs, etc. Because if you don't have those records accurate, then you won't get paid out on that grant, because you won't be able to prove that you've spent this money and what it's been spent on. So it's really important that right back throughout the whole of this, keep accurate records of what you're incurring. Again, in order to speed up any application process, it's really important that you track any spend against the relevant cost category. So within an Innovate UK grant, for example, you'll have certain cost categories that they're going to pay grant income on, whether it's labour costs, overhead costs, travel and subsistence, for example, capital equipment costs. But you need to be able to show exactly what spend has been spent on each. So again, going back to the start, if you use an Excel as a tool to store this information, have a separate column that lists down exactly what category each expense relates to, because it's going to be easier then just to do a pivot table to get that information out to put on your grant form.
No, I've done that, yeah.
Yeah, I thought it was good. Again, and where potentially you went wrong is that you need to make sure that you remove any indirect taxes from the claimed expense amount. So any VAT, the grant doesn't cover the cost of any tax. So if, say, for instance, you've incurred £1,000 of cost and you paid VAT of 20% on it, you've paid £1,200, but on the grant application, you can only put £1,000 on. You can't claim back that £200 of VAT.
Expensive mistake, that one.
Yeah. So just bear that in mind. And again, know your limits. So if you've only getting paid a certain amount out for the grant, especially if you're only getting paid certain amounts out for each cost category, make sure you keep track of what you spend is up to that cost category amount, because it might be a case that for the business, you're heavily reliant on that grant income to operate. Now, if you're incurring more than what you're going to receive in, who's going to pay for that? So again, it's important that you know exactly what potentially you can receive and how much you're spending, so that you can make sure that you're maximising that grant.
Okay.
And then the final point, which is a really important one, is that if you're claiming across multiple different grants, then you need to make sure that, again, you know what's being spent in relation to what grant, because what you can't do is claim the same amount on two different grants. So if you've incurred the cost of travel or material costs, for example, you can't put that material cost on two different grants. So it needs to just be for that one grant application.
Sorry for being cheeky. I know that it is wrong, but how do they find out?
Yeah, I know. That's the thing. At the end of the day, if it's two completely different grant organisations, they're not going to know. They're not going to know. But as a course of action,
I know. Yeah.
If the enterprise grows in size and potentially, and I'll try and discuss briefly if we've got time on investors shortly, then you're going to want to make sure that you're doing things correctly.
Okay.
You're not overclaiming on grant income. So they're just some tips with regards to if you are obtaining Innovate UK grants. There's loads of different ways that, especially with Innovate UK, that you can calculate things like labour and overheads depending on the business size and what you're actually incurring. So again, it's worthwhile just having a look at those before you make your application, so you know what's going to be most beneficial for the business. For example, with overheads, you can either look at specific overhead costs that you're incurring, or you can track it against 20% against labour costs. So it's good to do a bit of a comparison before you put your application in to see what's going to be more advantageous for the business.
What sort of typical thing do you put under overhead then?
So overheads are just going to be general expenditure for the business. So if you've got lab space that you're incurring light and heat costs on, for example, that's going to go in overheads. If you've got general repairs and maintenance or anything along those lines, again, it goes in overheads costs. So you're going to have to just weigh up, well, what do I think I'm going to incur on this project, and what's going to be the higher value, that cost that I'm incurring, or 20% of what the labour is. Quite often it's 20% of what the labour is. And then if that's the case as well, it's just easier in terms of calculation.
Yeah, so I will assume that different grant, they will have different list of overhead or something. So it's a bit like HMRC. Yeah, okay, fine.
Yeah. So you just need to make sure you know exactly what can be claimed where within the grant application. So with Innovate UK, again, genuinely, should I say, grants below £25,000, this self-audited, you just need to put a director's report in to state that this is the cost that I've incurred, and this is the proof of the expenditure. If the grant's above £25,000 but below £100,000, you need to then obtain an audit at the end of that claim. So on your last claim month, or quarter, you need to obtain an audit on then the whole of the project to show what's to get independent proof of that spend being incurred. And then anything above £100,000, you need to do an audit on the first and the last claim. So it's really important that, and again, with regards to that you know that in advance, because audit fees aren't the cheapest. So it's you need to make sure you factored that into your costs in terms of what's going to be incurred, rather than suddenly getting surprised with it on a final claim and you don't have any money to pay for an audit.
Yeah, and also it's interesting that the overhead for the Innovate UK is a percentage of labour only.
Yeah.
And not the, so luckily our grant, a big proportion is on labour, so we managed to get enough money for you. Okay, fine.
Yeah, so as I say, just on that, just make sure that you're claiming the right way and the most you can get from it.
Okay.
So in terms of really quickly, what you need to provide in an audit, and auditors, what we do when we audit things like grants is that we need to test a certain number of expenses to make sure that it is a genuine expense. So the likelihood is that we're going to need the majority of your costs potentially are labour. So we're going to need to see things like payroll reports or any invoices for contractors. And then we'll also select a sample of expenses. So a sample of expenses that are enough to showcase that the business has been operating in the correct manner. And we're going to need to see bank statements to see that they've genuinely been incurred as well. So this is all different. It'll all depend on the auditor's approach and what they want to look at. So there's nothing you can plan for with regards to that now. Just make sure that you've got readily available access to all of those costs. And going back to the start, it's probably easier if you get those stored digitally now rather than later. So then jumping on to other potential tax areas, one being R&D tax credits. Now, R&D tax credits are available to businesses that are incurring costs on research and development, so innovative spend. Now, if you are incurring costs on research and development as part of the project, and again, it's a relatively complex area, so you're going to need a tax advisor to help you with this, but potentially you can receive money back from HMRC. It's at a rate of 33% really, so £33 for every £100 that you're spending. Potentially you can get that back from HMRC. Now, that in terms of that calculation, what it means is that what HMRC do is, if you're the businesses that potentially we're talking about at the moment are loss-making businesses, or they're not profit-making businesses. So HMRC will allow you to enhance your spend in theoretically within a tax return, to state that actually, rather than 100% of that cost being spent, we'll allow it to go through at 230%, and then you can surrender that loss to HMRC for money back.
This is quite important for Enduring Net actually, because Enduring Net, as you can see, is really mainly R&D. Yeah,
exactly. So it's really important that you look into research and development, because potentially you could be receiving money back each year on that spend from HMRC. Now, depending on if you're registered for corporation tax or not, will then normally what an R&D claim is submitted within a corporation tax return. So you have to put a document together within your corporation.
But what if we don't pay tax because we're a charity anyway?
Yeah, so if you don't pay tax and you don't submit a tax return, you could just submit a separate claim, but it's a different process.
Okay, so we can still claim the tax credit.
Still claimable. The only thing with regards to research and development is if, and potentially Enduring Net will be caught by this, is if you receive most of your income, or the majority of your income, from notable state aid, Innovate UK being one, then that claim is restricted. You can still receive money back, but it's restricted, and you won't be getting, it won't be 33%. It'll be something along the lines of 11% that you'll be able to claim back rather than 33%.
Okay.
So you still can claim, but it's restricted from what the general small business amount is.
Okay.
Again, really quickly, financial modelling, conscious of time. So financial modelling, and again, we can go through this, anyone that has any questions later after, you'll have the slides, so by all means get in touch with me and we can talk through it. But financial modelling, if you're potentially, as a social enterprise, going to grow by way of investment, so you're looking for people to put money in, we mentioned at the start, limited by shares, possibly you need that structure, but you're also going to need to showcase to that investor what they're actually putting money into. So it's really important that you have some financial models in place, financial models that cover cash flow forecasting, and at least a 3-year projection on cash flow forecasting, and then also something to show profit and loss for development and profit and loss for potential revenue, and then also all that together pulled into a balance sheet. So again, going back to the start, Excel's possibly not going to be the best solution for you at that point, because you're not going to get any of this information out of it. What you could do is something like Xero or QuickBooks provides a lot of this information. So again, it might be worthwhile, if that's your plan, to seek investment, to get all of your back office set up properly now, so that it's easier and quicker when you come to the stage of potentially needing some money to provide all of this information to a potential investor.
Okay.
And then finally, with regards to other considerations, and again, this falls in line really with that route of growth. That if you've got an enterprise that's got decent growth potential, it's quite prudent to look into other areas as well, such as investment schemes. So if you are looking to get investment in, even if it's just friends and family investment, then it might be worthwhile looking into some kind of CDIS scheme or an EIS scheme, for the fact that you can potentially get tax relief for those investors putting money into a business. Now,
sorry, this is about Enduring Net investing somewhere else, or someone else investing
someone investing into Enduring Net.
Okay.
So yeah, if you're potentially seeking investment in for future growth or future projects, then potentially you'd want to register for CDIS and EIS, for the fact that for the first under
Who do we register with?
HMRC.
All right. Okay.
Again, it's an application process that it's quite a lengthy process, but it's something that will benefit the investor, because under CDIS, So this is where you're receiving under £100,000 of investment. That investor can potentially receive 50% back from HMRC. So if an investor in the CDIS put £100,000 into Enduring Net, they could potentially receive £50,000 back from HMRC.
Really? Okay.
Which is quite substantial. Any investment that you receive over £100,000 falls under EIS, so up to £1 million, and the tax reducer, so that tax back amount reduces to 30% for the investor. So again,
it's almost like the egg thing, isn't it?
Yeah. So if that's a route anyone's going down, potentially that's a really lucrative scheme, and it'll help you secure that investment, because a lot of high net worth individuals out there will only invest into businesses that have got a scheme in place because they know they're going to get that money back from HMRC.
Yeah.
So keep an eye on that. Again, other things to consider. Again, this is dependent on growth. It's not something for a small social enterprise, but if you are looking to grow, then again, you might want to, and especially if you are receiving investment, look into share option schemes. And this is going to be obviously dependent on how the business is structured. It needs to be structured by shares, but potentially it's a way to lock in key employees to that business. And people putting money into it will want to see that key employees are locked in, because they want to make sure that business is operating correctly going forward. And then, as you mentioned before, obviously, if you're moving outside of the UK, you need to make sure you've got your structure right. So again, it might be worthwhile, if you are limited by guarantee and you want to operate in multiple different jurisdictions, switching to limited by shares and changing the structure where you've got top company and then with loads of different subsidiaries in each entity underneath it. But you need a limited by shares business for that.
There's nothing wrong being a charity and limited by shares, is that right?
No. All you'd want to do with regards to that is just make sure that you've got it set up in some form of shareholders agreement or within the articles of association that all of the profits aren't paid out.
Yeah.
Because obviously the whole point of a charitable organisation is for the benefit of the community. So no one's going to put money into something that they think is just being paid out to shareholders to line their pockets as such. So you'd want to make sure, which you can do easily enough, that you've got rules in place within that business, even though it's shareholder driven, that profits aren't paid out to shareholders, or they're only paid out in certain circumstances.
Okay. Well, this is great. Just very quickly, because just now you mentioned about some fundings are taxable. So what about donation? Donation, if someone decided to give some donation, so it's different from prize money, isn't it?
Yeah, that's taxable income.
Taxable income?
Yeah.
Oh, okay.
So again, if you're not incurring enough spend within that year to offset against that income that you received, you'll have to pay tax on that donation.
How do I read more about that one?
I can send you something across after.
All right, then. Yeah,
a lot of this guidance is within HMRC's website, but I admit it's not easily available, or it's hard to find.
Okay. Thank you very much. Well, sorry, we overshoot with 3 minutes. Thank you. I think I got every ounce out of you now. Yeah,
perfect. So as I say, if anyone's got any questions after, my details are on the slide. By all means, drop me an email. More than happy to arrange 10-20 minute consultations with anyone.
Yes. So by the way, for whoever online, especially Manchester people, Chris was recommended to me by the Masood Entrepreneurship Center. So he must have very good reputation there. Thank you. Yeah, thank you very much, Chris. Thank you.
Cheers. Thank you.
Bye-bye.
Bye.